Well, welcome. Looks like we've got some attendees in the room already. As you may know, today we are going to be presenting on how parents can plan for U.S. universities. And we've got a brilliant guest speaker today, Gerry Chu, who I will be introducing shortly. We're going to be talking, first of all, about the planning and application process. And then later on, I'm going to be talking about the how to pay for it process. Why does the cost of college tuition rise faster than the rate of inflation? And how to prepare for it either with 529 plans, financing, pay-as-you-go, and other strategies. Before we get started, I'm just going to launch a brief poll over on the right-hand side, just to see if all of you are there and can see. I'm going to start it, and we're going to run it for a few seconds. Just want to see what answers you have. So you should see a question there with 4 answers. If you would kindly go ahead and give a few answers there. Okay. If you're watching this on a mobile phone, it might be on a sidebar. You may or may not be able to see it there. So. Okay, well, it looks like we might be having some technical difficulties with the poll there, so I won't keep that waiting too much longer. Well, I'll go ahead and get started by introducing our guest speaker here. So Mr. Gerry Chu is a lead educational consultant with ApplyIvy. He's been an educational consultant for 10 years now, has a Bachelor of Science from the University of Illinois and an MBA from the Kellogg School of Management at Northwestern. He's also done lots of interviews for Northwestern before he became an educational consultant and couldn't do that anymore, and has some experience on the corporate side with the brand management and marketing at Procter & Gamble, Colgate-Palmolive, Nestle, and Activision. His educational background also comes with a bit of experience as the former head of Kaplan Test Prep and Admissions. So whenever I've spoken to him, he clearly knows a lot about the U.S. university system and also about boarding schools and how the processes compare, how to prepare for them. And I'm very much looking forward to even learning a few things about the whole process from this presentation myself. So over to you, Gerry.
Great. Well, thanks a lot for that introduction, Tariq. So I'd like to kind of get started just by sharing a little bit about ApplyIvy. So ApplyIvy has been around for about 15 years now, and our mission is clearly to help our students gain admission to top schools, but we also are quite focused on helping our students to develop important skills and confidence along the way. Our approach is unique in that we provide a customized service and solutions by understanding each of our students' strengths, interests, learning styles, what's their ideal school environment, to really help them stand out. And so our approach, our methodology is, it's not a cookie cutter approach. It is unique to each of our students. And we also have an experienced team that leverages our methodology to help our students achieve along the way. And so what we're providing is not only help with the application process, but we work with a number of students, even the years preceding the application process, to help them to build their student profile, help them to achieve through their accomplishments so they have a great story to tell in their application. And so what we do is we really do have a focus on the long-term success of our students. So here's a partial list of schools that our students have been accepted to. Primarily U.S. universities and colleges. We've got a mix of universities, public universities, private universities, liberal arts colleges, as well as schools in the UK and Canada. So to that point, I'd like to start by talking a little bit about universities across these 4 different countries. The reason is that in the last few years, we've had more and more families who are interested in exploring their options, the different options. So many of our families that we work with, they are focused on the US, but they want to see what are the different options in the UK, Canada, and Australia. So I thought I'd share some of that information here in this slide and the next slide. So you can see that in the US, there's a large number of options in terms of universities. In Australia, there's 43, in Canada, 97, in the UK, there's 130, and in the US, there's 2,600. I thought for reference sake, you can also see the number of institutions in the top 100 QS world rankings, which is just one of the rankings that are out there, but it does rank the world institutions. And so Australia has 7, Canada has 3, the UK has 18, and the US has 27. Across these 4 different countries, there's also a difference in terms of the duration of the undergraduate degree. So some of you, many of you may already know this, but some may not. And so in Australia and in the UK, the typical undergraduate degree duration is 3 years. Now, of course, that sometimes varies with programs, and there are also foundation programs that are part of the education in Australia and UK. But in general, the degree duration is 3 years. While in the US and Canada, typically we're looking at 4-year university duration. In addition to that, I thought I would also share information about the tuition and tuition fees, especially since we're talking about planning ahead for your children's education. Certainly a big part of that planning process is budgeting, okay? And so if we look across these different countries, you can see that Australia and Canada are quite similar in terms of what to budget. And obviously that's going to be further impacted in the fact that the Australian education is going to be typically 3 years, and in Canada it's going to be 4 years. Okay. I think another thing to really notice, I think which is really interesting in this slide, is in the UK, the education, you can see that the tuition, the spread is quite large. You can see that it ranges from 113,000 all the way up to 429,000. And so, obviously one of your questions might be, well, what accounts for such a large spread? Well, the more expensive tuition typically is accounted for by medical school programs. And so, again, this is one of the big differences with the UK education, is that a student that knows that they want to study medicine, wants to pursue a medical degree, they can go right into a UK institution. And as opposed to in the US requires that students do 4 years of an undergraduate education, and then they would go on to a graduate education, whether that's pursuing a medical degree or law or business. And so I think that's one of the key things to keep in mind when comparing, especially US versus UK. Now back to the point about tuitions. You can see that the US, as it is perceived, is a more expensive education, but you can also see that the spread is narrower. It's not as spread out, and so that can be beneficial in terms of just planning purposes. And then finally, in the last row, I've also included the tuition plus the fees. And so especially when you are thinking about budgeting ahead for the education, and the fees usually predominantly are comprised of the room and board expense, which can also be dependent on where the institution is located. And so typically institutions that are located in a city, the room and board expenses are going to be higher. So that's just kind of a generalization, but that's what is reflected in that last row. Now, on to the next slide. I wanted to make some comparisons in terms of what's involved in the application process across these 4 different countries. Okay, so generally speaking, you can see across all the countries, students will have to submit their grades for the last 4 years of secondary school. Okay, then you'll see also that in Australia, Canada, and UK, students specifically apply to a specific program or a specific subject. Okay, so this is something that's going to be quite different in the US, where generally speaking, when students apply to the US, they can choose a program or a major they want to apply to, or they can even apply undecided and make that decision once they get to college, and after their first or second year, they can make that decision. Okay, so since students are applying to a specific subject or a program in Australia, Canada, and the UK, there are going to be specific subject requirements when the students apply to that specific program. So that's what that is something that accounts for a big difference between the US and these other 3 countries. Okay. Now, generally speaking, across all these countries, there will also be personal statements or essays that are required as part of the application process. And the US generally has the most essays for students to write. So in addition to a common application essay, many universities also have their own supplemental essays. And so, for example, a student that is applying to, let's say, 10 universities in the US could easily be writing 20 essays. Okay. So in addition to that application criteria, there are the deadlines generally are around the same time frame, but I think it is obviously important to note. So for Australia, the application deadline is in November in the year preceding when the student would want to attend school. In Canada, for Canadian universities, the deadline is January 15th. For the UK universities, there is a early deadline for students applying to Oxford and Cambridge, and that date is October 15th. And for all other programs, the deadline is January 15th. Okay. In the US, there is an early deadline of November 1st, but all other applications, the regular deadline is January 1st. Okay, so that should give you a little bit of an indication in terms of when applications need to be submitted. And I think one other thing to note, which is quite interesting, is for Australian universities, timing is really crucial. And the reason that it's very important is because students are required to complete their secondary school in order to apply. And so given that the timing for Australian universities generally starts at the beginning of the year, that means that many students, the students that are applying to Australia, they typically, especially if they're going to school here in Hong Kong, they would need to complete their secondary school, and then that following fall, they would submit their applications and then apply and then attend the following year. That's something to take note when it comes to Australian universities. Okay. So a next logical question that we often get from parents is, when should we start the application process? Okay. So typically, you can see that with Australia and Canada, it's best to start the application process in August. Okay. For universities in the UK and the US, we typically like to start earlier in the summer in June. And the reason is that the application process for those 2 countries is much more involved, especially in the UK. If the student is planning to apply to Oxford or Cambridge, there is a lot more involved in the application process. And in general, for students applying to the US, because there are so many essays, because there's so many moving parts, with the US application process, we usually like to start earlier in the summer. And the US process is generally considered as the most complex compared to the other countries. So it is good to start earlier. Okay. In terms of application considerations, Australia is very academically focused. And so what that means is that the criteria, if we go back and look at the criteria, they're really going to be focused on what has the student done in terms of academics, and how are they demonstrating their interest in the subject that they're applying for. Okay, Canada and the UK are still predominantly academically focused, but they're also interested in what has the student done outside of the classroom, especially when it pertains to the subject that they're applying to. And the US is a holistic process. So certainly the US, the universities, they're looking at the student's academics, but they really want to get to know the student as a whole, who they are, what are their interests, what have they done about those interests. And so I'll also talk a little bit more about this holistic emphasis in the example student that I'll be talking about shortly. And so this student case that I'd like to share a little bit of information about, her name was Clara, where she actually just went through the application process. So she's a very relevant case considering the impacts of COVID and having the most relevant information in terms of the application process. Okay. So Clara, she's an ESF student, and we started working with Clara in year 11. So we've been working with Clara for a few years now. Okay. Now, in terms of interests, Clara had interests in music, sports, and psychology. Okay. And in addition to that, she had a strong interest in studying neuroscience. Okay. And in terms of universities, while I was saying earlier that a number of our students are exploring different options, I would say that many of our students do choose to apply to the US and Canada. Some also want to apply to the UK. And this past year, we had some students that were applying were interested in the Australian option. Okay. Clara was really focused on the US. Okay. She appreciated the flexibility of the undergraduate education in the US, but she also wanted the ability to have research opportunities as an undergraduate, specifically in those areas of neuroscience and psychology. Okay. And so when we started working with Clara, we started by assessing what were her interests, what were activities, what were her experiences, what had she been involved in, and then we started to help her to build her profile over the next 2 years, preceding the actual application process. Okay, and the goal was to have Clara achieve some significant accomplishments independently, and to demonstrate her taking on the initiative based on her interests. And the reason is that students tend to be more motivated and take the initiative in areas that they are most interested in. So as we worked with Clara, we helped her to build her profile. One of the things that we helped her to do was initiate a psychology club in her school. Her school didn't have a psychology club, and because she had this strong interest, we advised her to start that up. And along the way, we also gave her guidance in how she could propose this club idea to her school. And once it was approved, how she could continue to build interest and keep the club members' interest as she continued to run that psychology club. She also had an internship at a biotech organization in Science Park. And so that was something that was a valuable experience for her. that we also helped her to apply for. She also sought out a mentorship with an HKU graduate student. And so this gave her some valuable research experience that certainly helped her in terms of building up her profile. After that, I would say that during her year 12, she continued to build on this psychology club. And over that year, this was the year that COVID struck, and with students distance learning and studying from home, she noticed that there was, an increasing issue with the mental health of students that were cooped up at home and looking at the computer screen all day. And so we helped Clara in terms of seeking out a psychologist and collaborating with a psychologist to offer advice to help with the mental health of her fellow classmates. Okay. And then last summer, we thought that it would be a great idea for her to get involved in a summer research program specifically studying neuroscience. And so we identified a great program for her to apply to, helped her with the application process. She was accepted into a selective program. And from that experience, she gained some invaluable experience because she was part of a small class that was online. And then she gained some great experience being mentored by an actual university professor in the US who helped her to put together a research project. So by the end of the summer, she had an actual research paper that she could take ownership of. So that experience was quite valuable for her. And then finally, with all of these experiences, she gained the confidence to go to her school administration and suggest a mental health initiative, given that her classmates were struggling with mental health during this COVID period of studying from home. And so she presented this idea to her school administration. They actually initially declined her proposal, but we encouraged her to stick with it, change her proposal, take a different approach, and eventually it was approved. And so I think that this was another one of her significant accomplishments. And you can see that all of these activities and accomplishments were related. They really demonstrated her strong interest in psychology and neuroscience, her commitment to pursue these interests outside of the framework of what she had in school. And in addition to that, she even used some of these initiatives to help her community. And so this is how we helped Clara to build a very strong profile, and it really helped her to stand out through the application process. And so the end result was that she was actually accepted to Emory, UC San Diego, and Brandeis. And Emory is the number 21 ranked university in the US. And in addition to that, she was also accepted to a highly selective research program at Brandeis that has only 18 students, and she was actually offered a scholarship of $82,000 at Brandeis. And so that is the school that she has chosen to attend, given that she was really seeking out research opportunities as an undergraduate. Okay, so to summarize, when applying to U.S. universities, there are a number of ways that students can stand out. So one of the most relevant and what we've seen timely impacts that we've seen in the past year is test optional policy. And so all universities in the U.S. have gone to a test optional policy, and that means that students can choose to submit their SAT or ACT. Okay, well, the impact of that policy has been that for the top 50 universities, there's been a dramatic increase in the number of applications that they've received. All the Ivy League schools have seen an increase of 20% increase of applications, and Harvard even saw an increase of 50%. Okay, so what this means is that it's become even more competitive for students that are seeking admission to the top universities. And so when we talk about, what are the different criteria, most students applying to these top schools are going to have excellent academic grades. The SAT and the ACT now are test optional. And so the best way to really stand out are through activities and experiences. Okay, but it's not just enough to get involved in activities and experiences. It's important to really take a strategic approach. And so you can see through that example that I gave of Clara that we took a very strategic approach. We took her interests and we helped her to build on those interests, especially linking it to what she wanted to study in university. And so, again, it's important to be strategic. And in addition to that, it's also very important to exhibit important skills through those experiences and through those achievements. Okay, we know that from our experience and through our research, we know that there are 10 important attributes and skills that universities are looking for. And so when we work with students, we really direct them on how to develop those important skills and how do they exhibit those skills through those experiences that they will be writing about and talking about in their essays and their interviews. So some of the important skills are going to be demonstrating leadership and demonstrating grit. And so as we're working with our students, we're helping them to develop those important skills. So those are some of the key ways that students can stand out when we talk about planning ahead for the application process for U.S. universities. Okay. So really briefly, just because we're running a little bit short on time, I'll go through a timeline. So we know that at grade 12 or year 13, students are going to be submitting their applications, and so they'll be completing their essays. The year before, students should be demonstrating leadership, exhibiting initiative in their activities and experiences. Hopefully, they'll also have some awards and distinctions. And this is also the year that students should be nailing down their school list, what schools to apply to. We still encourage students to take the SAT or the ACT during this year, and hoping that things will open up with the pandemic, that students will still have an opportunity to visit schools this upcoming year. And we always emphasize that it's so important for students to make the most of their summers. So summers are a great way for students to stand out through their activities and their experiences. In grade 10, we encourage students to get deeper involvement in their activities and community service, gaining achievements in their interests, and looking at those last years in terms of planning for their academics, especially given that many of our students are in the IB curriculum. And so it's important to start planning ahead for those last 2 years. Students will also get involved in test prep, and then also, again, making the most of their summer. And grade 9 is an important year just to get involved in activities and getting involved in community service. And so even before that, you can plan ahead by encouraging your kids to gain exposure and explore different activities so that they can start to identify their interests. So hopefully that helps in terms of thinking ahead and planning ahead for your child's education and the application process to U.S. universities. So that concludes my portion of the presentation. I'll pass it over to Tariq now.
Well, thank you very much for that wonderful presentation, Gerry. As expected, I did learn a few things, especially about timelines. But I think what I especially liked was how you finished at the end about when parents and students, of course, should be preparing for certain things at certain milestones. So one of the things I would have liked to ask on the poll question was, how many years away are you actually looking at attending university? I know sometimes parents will come to you a year or two before, sometimes maybe about 5 years before. And clearly what I'm going to be talking about here has relevance both to parents who are about to go in and to even parents of very, very young children. Probably won't surprise you how many, parents of newborns I have saying we need to start saving for university. So very good. So with that, I'm going to go ahead and pull up my presentation at the moment. So I'm going to do my screen share window. Okay. All right, there we go. Hey, Gerry, can you just confirm that you can see that on the screen?
Yep, we can see that. Looks great.
All right, excellent. And as you may have noticed, PowerPoint has started this new feature where they annotate text at the bottom. So hopefully that will be useful to you who usually turn on your subtitles. So my portion of the presentation is going to be focused on another part of U.S. university planning, which is paying for it. And usually when I'm presenting this to a mostly US audience, I spend quite a bit of time talking about 529 plans, but usually many of my attendees here are non-US taxpayers, so I will be talking a little bit more here going forward. So first of all, an important disclaimer. And a little bit about me, for those of you who may not know me already. My name is Tariq Dennison. I am a fee-only cross-border wealth manager. I run 2 parallel businesses, one in the US, one here in Hong Kong, where we manage discretionary investment accounts for clients. And around that, we provide a lot of the wealth management and financial planning services, which includes figuring out how much you may need to save 10 years ahead of time for 4 years at Harvard or whatever that particular goal might be. I've been in the markets now for 23 years and counting, and I've worked at a variety of investment banks in New York, London, Frankfurt, Toronto, and I've been here in Hong Kong for 11 years now. My own alma mater is the University of California at Berkeley, where I've earned a master's in financial engineering. Before that, I have a degree from Marquette University in Milwaukee, Wisconsin. I now also teach at a university in Singapore, 2 classes, fixed income and alternative investments. And if you want to read more about my way of thinking, I recommend a copy of my book, Invest Outside the Box, 300 short pages in 11 chapters on how to understand different asset classes and strategies. So that's me. I am the investment and numbers nerd looking at the Financial Times every day to figure out how to get a good rate of return on them. Now, the interesting thing about talking about education is that education really touches many different parts of wealth management. So usually on wealth management, I focus very much on the investment side. But of course, you can't really talk about investment without talking about what your investment goals are and talking about how do you prepare for investment should something happen. Should, say, you lose your primary source of income or someone gets injured or so on like that. So there's relationships with insurance. And then many clients I talk to here, property is related as well, because when they send kids to, say, study in the US, usually they won't even be hiring room and board. Sometimes they'll be buying a house there and planning for immigration and planning for their kids to become US residents or US citizens. So there's a lot of things that go around the topic of education that we tend to cover in wealth management. My focus really is investing, and I do deal with some of the pre-immigration tax planning and other things that go into it. But this is just a grid of some of those other areas related to planning to go study in the United States. Now, the 3 main areas I'm going to talk about, the first one is a macroeconomic question, is the question of college costs rise faster than the rate of inflation. Why is that, and should we expect it to continue? This was an updated version of that chart that you may have seen, that when you see, the average rate of inflation for the past 20 years has been 2% per year. And of course, you look around the things that you buy and you say, well, the prices of those things are going up a heck of a lot faster than 2% per year. And what this chart shows is that for the past 20 years, 3 types of services generally, hospital services, college tuition, and college textbooks, have had their costs rise much faster than the rate of inflation, while other things, namely televisions, electronics, computer software, toys, have actually seen their prices fall over the past 20 years. If you've bought a TV recently, you know that you've probably paid less for that TV than you would have for a TV 20 years ago that was actually nowhere near as good. And even a car, for example, a brand new car, actually the cost of the car hasn't even really risen that much, despite the fact that it has many, many new features. Now, one of the things I've written about in a recent article is what is the difference between the red goods and services, the things that have gone up faster than the rate of inflation, and the blue goods, and you'll notice they're mostly goods, with cell phone services being the one service, that have fallen or roughly stayed flat. One of the biggest differences is those things that have fallen or stayed flat in price have faced a lot more competition. Namely, we've been able to outsource manufacturing to China, and lower cost productions and use of technology has allowed the cost of those goods to fall. Hospital services, college tuition and fees, college textbooks, those are three things we have not been able to outsource to China. In fact, those are also three things in which the least amount of technological disruption has happened. The college experience that many students have faced now in many ways is very, very similar to what we would have faced 25 years ago or even 50 years ago. And if anything, what we're seeing is competition on the demand side, where more and more Chinese students are coming over, paying all cash, and being able to push up the price of tuition and textbooks that way. So that's a very, very quick and dirty macroeconomic picture on why college tuition and textbooks have risen much, much faster than the rate of inflation. Now, another driver, which I don't think gets quite as much attention, but you'll notice in the previous slide, housing, real estate has actually risen only slightly faster than the rate of inflation. And one of the drivers of anything that rises faster than the rate of inflation generally is when the person making the buying decision is not the one paying for it. In the case of college, a rising percentage of college costs paid in the United States over the past 10 years has been financed with debt. And this is the ballooning student loan bubble that you may have heard about, which in many ways has paralleled the housing bubble and the real estate bubble that you've seen in the 10 years before that led obviously to the global financial crisis. Whenever people can borrow unlimited amounts to buy something, the price of that thing that they can buy with debt can rise much faster. This chart, as you'll notice, ends in 2013 when the total amount of student loans outstanding was only $700 billion. Since then, it has more than doubled to $1.7 trillion, most recently reported by the St. Louis Fed in early 2021. So one of the things to keep in mind is whenever you're entering a market where those competing with you can borrow more and more money to push up the price, that's one thing I again tend to watch out for. But that's one of the main reasons I would also say you may or may not expect the cost of college to come down. When you look at the amount of money the current Biden administration proposals are looking at pumping into the educational system. More and more money chasing after the same goods or services tends to push the price up for better or worse. I'm not judging it. I'm just saying we need to plan accordingly. One of the things I do want to talk about, and I'm going to talk about a little bit later on, is the concept of return on investment. So even though we've talked about the average cost of college rising faster than the rate of inflation, just like when you buy a piece of real estate or just like when you buy a stock, you know that not all colleges cost the same amount. This is an old slide that I created back in 2016, 2017, showing how different the costs of 6 different private universities on the top half of the slide versus 6 different public universities, which have in-state tuition options, compared. Again, this was back in 2016. And as a measure of how relevant these different universities might be to Hong Kong residents, I also looked at the number of LinkedIn alumni, the number of alumni who put that university as a university they attended, who are based in Hong Kong here. So perhaps not surprisingly, University of California had more than 2,000 alumni in Hong Kong, and this is just on LinkedIn. So this is my ranking, which again, I find this to be a very useful slide for comparing, where can you go get a good degree for $10,000 a year in-state versus $50,000 a year private. I'll go ahead and leave this to you for comparison, and I've cited my source down at the bottom if you'd like to get some updated data. In terms of top rankings, now I tend to view rankings with a bit of a grain of salt, but as Gerry will tell you, people still very much look at the rankings. They look at the US World and News Report, but then globally, there's another site that I occasionally visit called the Times Higher Education. The acronym there is THE. That's why I say the global rankings. It's actually the acronym for Times Higher Education. I just took a screenshot of the top 5 universities here, and you will notice 4 of the top 5 universities in these rankings are US universities. Oxford here was ranked slightly higher. You can look at other statistics here like total number of students per staff, male-female ratio, and so forth. Again, I will leave this for you as just another source you may or may not have looked at. When we look at financial returns, so one of the things I say is I'm very much a believer in not paying up for something at any cost. So for example, you look at Amazon stock. Should you buy Amazon stock just because it's there, just because it's a $1.5–2 trillion company? I very much believe in what return, whenever you make an investment, how do you know what you're going to get back from it? If you pay $50,000 a year for 4 years for a degree, are you going to earn that much more than from another university, which you might pay $20,000 a year for? Now, it's not purely financial. You, of course, with a university education, you get the alumni network, you get the prestige, you get the experience of having gone there. But this pay scale report that I have right in front of you shows you what the early career and mid-career salaries are for graduates of these 10 universities. And surprisingly, the Harvards and the Stanfords, which you might expect to be at the top, are actually not at the top. At least according to this study, graduates of Harvey Mudd College, an engineering school, ended up with higher early career pay and mid-career pay than Harvard or Stanford graduates. Although if you look at the right, a lot of that may have to do with what these students studied. So it's not just about where you go, but what you study. And what Gerry mentioned earlier, for psychology, there are some schools which have really highly rated programs in some fields rather than others. So that's on the return on investment side. On this next one, this is one of the many spreadsheets which I run, and I know many parents and even many students may not have run this. Believe it or not, before I chose Berkeley and before I got my Berkeley degree, I ran a spreadsheet very much like this, estimating that if I took a year out of work and paid at that time around $37,000 for 1 year of a master's degree, how long would it be before I made my money back, and what would my internal rate of return be on that investment? So here, I've just made up numbers. I've made up 2 columns of data for University 1, where we assume we're going to pay $50,000 a year for 4 years, and then make an extra $20,000 a year starting the first year of working, and then that grows, followed by University 2, where we only pay $20,000 a year for 4 years, and then maybe we only start out making an extra $10,000 a year the first year out, and then that grows as well. Which one is a better return on investment from a purely financial point of view? I don't want to spend more time in this presentation going into this one in so much detail, but those of you who are familiar with IRR calculations basically know that this is how you look at return on investment. How much do I put in versus how much do I get out? And this is just the financial side. You've got to look at how much do you put in versus how much you get out on the non-financial side, which may or may not fit on a spreadsheet quite as well. Point number 2. So we've talked about the big picture numbers on the rising cost of college, how to calculate the return on investment. From a personal planning point of view, how far ahead do you really need to look when you say, I want to save to send my 5-year-old, my 10-year-old, my 15-year-old to university, and how much will I need? Now, there are 3 approaches to paying for college, as obvious as it may sound, but I think it's important to list these out to decide which of these are going to be your plan. Plan number 1, which most people I work with will try and follow, is save and invest before your child goes to university. And these are the parents who have a newborn or a 5-year-old or a 10-year-old saying, I want to save some money every month to make sure that I've got a fund of $200,000 sitting there ready to pay this tuition and fees bill by the time my child gets to university. So this is save and invest every year. And as a footnote there, I'll say maybe you don't just save and invest for your own child. You might even save and invest for your grandchildren and let the power of compounding work for you. I'm going to later mention something called a Dynasty 529 plan, which is, at least for me, is a fairly new idea, but is one that I want to mention for those of you who may or may not be interested. Option number 2, which I hear about as well, is the pay-as-you-go option. Now, for many parents I speak to in Hong Kong and Singapore, which are used to paying fairly high private school bills for Hong Kong International School, Harrow here, they're already used to paying fairly high amounts every year for secondary school. So they just figure when they go to university, it's just another bill that they're going to pay out of current income, just like when they were in primary and secondary school. That's the pay-as-you-go approach, and that may work for some budgets and not others. Option number 3 is where maybe you didn't save ahead of time, maybe you don't want to pay as you go, but you choose to take out a student loan. You borrow and then you pay it back later. And that matches very much of this is a good investment if your rate of return on that university education is higher than what you borrowed, and especially when you look at the interest rate that you pay. With interest rates as low as they are now, even if you've saved that money, some savers might have looked and say, hey, you know what, my investments are making 6-7% a year, and I can borrow at 1-2%. Why on earth wouldn't I just borrow and then let that college fund compound and grow and fund my grandchildren, great-grandchildren, and so on? So there's very different approaches and very different ways of looking at this, depending on what your saving and investing style. Now, let's say, for example, your assumed number is, I want to save $200,000 for 4 years of college. Now, unlike retirement, much of what I do on the financial planning side is helping clients save for retirement. When you save for college, usually you have a fairly fixed target date in mind and a fairly short running horizon. You're not going to have to pay for 50 years of college like you might for retirement. You might only need to pay for 4 years of college. And because, unlike the cost of living in retirement, the college costs that we've seen rise much faster than the rate of inflation, I often see if my rate of return on investment can keep up with the rising cost of tuition, I'm happy with that as an absolute return benchmark. Sometimes we'll say, I want my investments to outpace the rate of college tuition increases by 1 or 2% per year, but that is a very different benchmark than just saying I want to outpace inflation by 2 or 3% per year. That's why I mentioned the rising cost of college versus inflation. Now, as a benchmark, there is a 529 plan. Now, a 529 plan is a U.S. tax advantage college savings plan called privatecollege529.com, where you can basically pay today for the tuition of whenever your child may attend university. Now, when my first son was born, I went ahead and I put a certain amount of money in a private college 529 plan for him on the event that he attends one of those 270 private U.S. colleges that participate in the program. If he doesn't, I'll need to roll it over to another beneficiary. But if, let's say, he goes to Harvey Mudd, which is one of the colleges on that program, I have already locked in 1 year of Harvey Mudd tuition at the 2005 rate. So that's one way of doing it and locking in the rising cost of college, but that only really works for those 270 private colleges and universities. Another way of breaking it down, $200,000 a year for 4 years of college, assuming that your rate of return is equal to the rise of tuition. Save $10,000 a year for 20 years, save $13,300 a year for 50 years, $20,000 a year for 10 years, or $40,000 a year for 5 years. It's not really rocket science. I often say with all of this, don't overthink it, don't make it too hard, keep it simple, and get started today if that's what you want to do. Now, in the case of a scholarship, I often say I never hear anybody said, "Oh crap, I oversaved. I saved too much for college." The fact is that if you do get a scholarship, if you do get financial aid, if you do find a cheaper school, or if you do find I'm getting a good return on my investment and I can borrow at 1 or 2%, it's always good to have the money and not need it than to need the money and not have it. In the case of the Dynasty 529, as I'm going to mention it later, you can always roll the money to your younger niece, your younger nephew, your grandkids, your great-grandkids, wherever it might be. It's better to have that money and not need it than need it and not have it. So just for reference, very, very public confession here. When I took out my Berkeley degree, of all the different ways I could pay for it, I had the cash on hand, but I chose to take out a student loan at 2.675% fixed interest. I think it was for 30 years. And I'm continuing to pay the minimum on it even today because I believe I can earn a higher rate of interest or a higher rate of return investing that money elsewhere. One of the models that I use for planning when you put money in, when you take money out, is what I call a runway model. Namely, that the only money you want to have in bonds or in low return fixed rate investments is money you're planning to take out fairly soon. So let's say within the next 2 years or so, and anything that you're not going to take out within the next 2 years, you want to have that in stocks, in real estate, in some high growth asset that's going to outpace the rate of inflation and pay you rising rates of return. Now, over here, you'll notice that the length of that runway, I vary from 2 years for an aggressive investor to 7 years for a conservative investor. And I have arrows showing you that you might shift that back and forth depending on whether you think risk assets are cheap or risk assets are expensive. I will do a whole other presentation just on how this runway model of asset allocation works. But this, in a nutshell, very rough rule of thumb, is why the glide path I'm going to show you later of starting out with mostly stocks when your child is young, and then shifting more and more to bonds as your child approaches that college withdrawal age, that's where this idea comes from. What's another bit of the rationale behind it? Why do you say, well, if it's long, invest in stocks, if it's short, invest in bonds? The reason is that stocks over long periods of time don't really move in a random walk. There tends to be degrees of mean reversion. And when you look at really, really long periods of time, you find that the worst period for stocks ends up actually being better than the worst rate of return for bonds. Now, I know this is a bit of a messy table, but what you'll see all the way on the left is the worst year, the worst 1 year period that 5-year bonds ever had, going all the way back to 1926, was being down 5.5%. And if you go 2-3 years, it was really, really hard to lose money in bonds. Whereas if you look at stocks, the bottom two categories, the S&P 500, or even more aggressively, a small cap value index, there was a time where you could very easily lose 67, 75% of your money in stocks in a very, very short period of time. Now, if you look at the start date there, that start date of that worst period was July of 1931, which was the middle of the worst market crash in world history. So obviously, if you don't think you're in the middle of that, you might not lose half of your money quite that rapidly. But if you look at all the way out to 20 years, you'll notice that the worst 20-year period for investing in small cap value stocks, which is something I look at quite a lot, was a period where you only earned 4% per year for a period of 20 years. Now, the worst period for the S&P 500 or for 5-year bonds was actually not that bad. Now, again, these were the worst year periods starting in 1929, comparing with the worst 20-year period for bonds, which started right at the beginning of the US entering World War II. So this is another reason for that runway idea, is the idea that even if you have a really bad period for stocks, there's a tendency that they recover. In fact, over the past year, we saw how quickly stocks recovered after crashing in March of 2020. One of the very important assumptions that I get grilled on quite often is, okay, well, wait a minute. You've just assumed that we put money into a stock portfolio and you say it's going to earn 7%. How on earth do I know that a stock portfolio is going to earn 7%? Again, this is a topic which I will do a whole other presentation on. But here I've got a very, very quick and dirty example using just one stock you may all be familiar with, Microsoft, showing you the 3 components for how to assume the rate of return on a stock. On the left, I show you what was the rate of return you would have earned if you had bought Microsoft in 2000 and held it for 10 years until 2010. You could have put $10,000 in Microsoft, and 10 years later, you'd have only $7,000. You'd have lost 30% over 10 years, which is a loss of 3% per year. That's a combination of 3 factors: a dividend, the actual growth in the business, and a change in the valuation of Microsoft stock. If you look over in the lower left, initially, Microsoft didn't pay a dividend in 2000. They only initiated it in 2004. And over the entire 10-year period, the Microsoft dividend only contributed about 1% per year to your return. So clearly in 2000, you were not buying Microsoft for the dividend. Now, Microsoft was expected to continue growing. In fact, its earnings per share rose from just under $1 per share in 2000 to over $2 a share in 2010. So its business kept growing throughout that decade. It more than doubled over that 10-year period, 8% a year. So how is it that you went from no dividend to a dividend and more than double earnings, but you still lost money? Well, the reason was in 2000, you paid way too much. If you bought Microsoft in 2000, you paid 40 times earnings. And over the next 10 years, Microsoft went from trading at 40 times earnings to 11 times earnings. That put a 12% per year headwind on your returns. And that's why, despite 8% growth, your Microsoft shares returned you a minus 3% rate of return over that 10-year period. Now, over the following 10 years, from 2010 to 2020, Microsoft did the exact opposite. at least on the valuation perspective. Now, from a dividend and growth perspective, same story. Now, instead of 1% per year from the dividend, you actually get 2% per year from the dividend because you bought it at a starting dividend yield of 2%. Believe it or not, in 2010, many analysts thought Microsoft's best days were behind it. They didn't think Microsoft was going to continue growing. They didn't see the cloud services picking up. They didn't see Microsoft Office on the iPad. So rather than Microsoft's business, Microsoft's earnings not growing at all, in fact, Microsoft's earnings per share went from $2 a share to $5.70 per share over those 10 years. They more than doubled. They grew at an average of 10.5% per year. But then the big kicker, the big tailwind is that change in valuation. You bought Microsoft at 11 times earnings. Now it's trading at 35 times earnings. That added an extra 12.5% per year to your rate of return. And that's why if you bought Microsoft in 2010, you got a 25% per year rate of return. I have been so obsessed with this example. I have been trying to find an example of Microsoft 2010 situation again and again and again, because that's how we earn higher rates of return. But again, I will go back to this later. This is very important for understanding whether S&P 500 or Hang Seng or whatever other stock fund you invest in will deliver you a 25% or a minus 25% rate of return over any time horizon. Now, how do I fit this into my actual plans? This is a screenshot for my 529 plan advisor page, and this shows you what's called a glide path. This shows you for a child of a given age, 0 to 3, 4 to 6, 7 to 9, what percentage of that child's account do I have invested in stock funds versus bond funds, and how does that mix change as the child ages? One of the reasons I use the Utah My 529 plan is that it automatically shifts the child's portfolio every year on their birthday. So again, I will go ahead and leave this to you with the big disclaimer that this is not investment advice. This is just one of the glide paths I use for 529 plans. Now, speaking of 529 plans, I'm going to go ahead and tell you what is this 529 I keep mentioning. Now, overall, most of what I say about 529 plans applies for U.S. taxpayers. Applies for those who pay U.S. taxes and want to use it as a tax shelter. But some of the things I might say also apply to migrating students. If you are not American, you don't pay U.S. taxes, but your child is going to go to the U.S. and perhaps become a U.S. taxpayer, perhaps get a green card, perhaps stay and work there, there are going to be a few things that we might want to mention there as well. So first of all, what is a 529 plan? A 529 plan is just a tax-advantaged way for U.S. parents to tax shelter the investment gains for college. As you may know, we Americans, if we invest money and we make a dividend, we make a capital gain on it, we'd have to pay tax on it. If we put that money in a 529 plan, it can grow tax-free and be taken out tax-free for college. That's it. That's all it is. 529 plans are actually written into the code as an exemption for plans run by states. So every single 529 plan is run by and sponsored by a state. And that technically makes them a municipal security. That's where they get their tax exemption from. The first 529 plan was a Michigan prepaid tuition plan started in 1986. And the types of financial plans were very much liberalized and expanded in 1996 to include, for example, a state being able to run a portfolio of mutual funds for you and give the tax-free advantages of a 529 plan. You can choose any state's 529 plan. It does not matter whether or not you live there. It does not matter whether you live in Hong Kong. If you want to choose Alaska's 529, Utah's 529, New York's, Florida's, it's up to you. You can choose them. The main reason that people choose the 529 in their own state is that if you live in a certain state, that state will often give you extra tax breaks to residents. For example, I still have a New York 529 plan from when we lived in New York. And New York State would exempt up to $10,000 per year of contributions made into a New York State 529 plan from New York State and city income tax. Obviously, with a 10% state and city income tax, that was a meaningful tax break. I will take that $1,000 a year tax break. Thank you very much. Now, there's no other tax break other than those state tax breaks that some states might provide. There's no other tax break on the way in. You buy these so that they're tax-free on the way out. That means they're very Roth-like, if you know what a Roth IRA or Roth 401k is. The 2017 Tax Cuts and Jobs Act expanded what you can use 529 money for. Now you are not only limited to using it for university, you can also use it for private pre-university schools, for private high schools, for other private schools you might use it for ahead of time. That solves the problem if you've got too much money in your 529 plan, but something we want to consider as well. There's no limit on how much you can put in a 529 plan per year, but you do have to look out for gift tax, and that limits on the overall balance you're allowed to have in a 529 plan, which I'll mention next. You may have also heard of something called a Coverdell ESA, which used to be called an educational IRA. What are the differences here? The 529 plans have no limit on your income, on the income that you can have if you want to contribute to it. The only real limit you have is an annual gift tax limit. Now, again, this doesn't mean you can't put in more than $15,000 a year. It just means that if you put in more than $15,000 per year, you're going to eat into your lifetime gift tax exemption. Again, this only applies to Americans. There is a special rule allowing you to front load 5 years of contribution. So this is a very typical thing. I say, if you're a parent and you want to put in $75,000 into your child's 529 plan, go ahead and do that now, and that's your next 5 years contributions. You can't do it again until year 6. Obviously, when you put in that $75,000, it means that you get 5 years of tax-free growth up front rather than having to stage it out. That can be a pretty nice benefit. There's a maximum balance of about $300,000 US, which is basically indexed to what 4 years of university at the most expensive college in the country is. That's really what it is. The whole point of that, quite simply, is they don't want you to have more in a 529 plan than you can actually realistically use to spend on a college. That's really all of what it comes to. Now, it's limited to, your investment choices are limited to whatever mutual funds that state has chosen to offer in its 529 plans. That is, in my view, the biggest limitation of a 529 plan. You can't put it all on Microsoft stock or Bitcoin or Tesla. Even if you wanted to, you've got to put it in, for example, those mutual funds I showed you earlier. You are also limited to only making 2 rebalancing trades per year. So you can't day trade. You can't even rebalance monthly. You can rebalance twice a year, and that's it. And your other choice, of course, is the private college 529, which I mentioned is a way of locking in the costs of certain colleges. Now, legally, technically, a 529 plan is an asset held in the parent's name, which has certain advantages if your child wants to apply for financial aid. But you also are able to transfer it to another relative without penalties. It can be considered a gift if it is not a relative. There's a whole flow chart for this. And the reason for doing this is if you want to create what's called a dynasty 529. You deliberately put too much in your child's 529, let that grow tax-free. You maybe don't use it or you don't use it all, and then you transfer it to your child's child, to your grandchild. Let that grow, maybe don't use it all, and then transfer it to your great-grandchild. And you build up effectively this tax-free college fund generation after generation after generation, with the big assumption, of course, that U.S. tax laws don't change. That $15,000 a year, by the way, is the 2020 and 2021 gift tax limit. Coverdell ESAs, most people don't have them, so I won't say too much about them. You can only contribute to them if your modified adjusted gross income is less than $95,000 US or $190,000 if you're married filing jointly. And you must draw out all the money by age 30. So much more limiting on that side. You can only put in $2,000 a year. There is no maximum balance, quite unlike a 529. But with $2,000 a year, it's going to be much harder to get more than $300,000 in them. The biggest advantages of them is that you have much more flexible investing options. You can put it in whatever you want if you find an investment that's going to make 100x. Both of them are Roth-like. Basically, you don't get a tax break on the way in, but they're tax-free withdrawals when you take them out. How significant is the tax benefit? I, again, run lots and lots of spreadsheets on it. This one is a very simple example, assuming that you put $100,000 into the plan up front, or you have $100,000 up front. And let's say on the left, the first column assumes you have a 529 plan, and because you're limited to mutual funds, you only make 7% a year. And let's compare it to a strategy where, let's say, I run a really good tax loss harvesting program outside of 529, but then I have to pay taxes at the end when I sell my investments to pay for college. And then the third option at the end, let's say, is most flexible. Maybe I get to do a little more rebalancing. I get to take some profits, but I can earn 9% a year, but I have to pay tax every year. And what we see is that if we run that forward over 15 years, if I am somehow able to defer all my taxes to the end and pay 37% tax at the end, I still end up with about $40,000 less than if I was able to keep it all tax-free, even earning 1% less per year. So 236,000 after tax versus 275,000 tax-free. And as you can see, both of those are higher than if I had to pay tax every single year, even if I earned that higher 9% per year rate of return. So obviously, garbage in, garbage out. It's all about my assumptions, but this shows you how significant that tax break can be if you so wish to use it. This flow chart is a lot for me to go over. I'm going to go ahead and just leave it here for your viewing. But what this flow chart does is it helps you figure out, does your withdrawal from a 529 plan get that tax exemption? Can you take a 529 withdrawal and have it exempt from federal income tax? And basically, it helps you walk through what is a qualifying educational expense: tuition and fees, room and board, books and supplies, student loan repayment, and so forth like that. So I will leave this flow chart for you. Please go ahead and go through it to try and decide if your 529 withdrawal is tax-free this year. What about non-US parents? Let's say you're not a US taxpayer, but maybe you have kids who are already US citizens, or maybe you're planning to send your kids to the US and they're going to live and work there. They're going to become US taxpayers. There's a few tax planning things that you might want to keep in mind. Now, first of all, any money held in the name of a Hong Kong parent who's not a US taxpayer is effectively already a tax-free account. It's better than a 529 because you never had to worry about, it's already in a tax shelter. So keep as much of that outside of the US in the name of the non-US taxpayer for as long as you can. Now, if your child is planning to eventually become a US taxpayer, it is better to plan ahead. There are a few things to keep in mind. One of the most common tools for this is something called a foreign grantor trust. I can do a whole other separate presentation just on foreign grantor trusts. There are other structures as well, but that's where you may have heard the term. If you are a non-US parent with kids who are going to be US residents, that's a good tool for you to learn about. One of the biggest traps I want to warn you about now is giving gifts of appreciated assets. Let's say, for example, you bought a property here in Hong Kong 20 years ago, let's say for 100,000 US dollars. Now it's worth $1 million US dollars. Do not gift that to your child because they will inherit the cost base and possibly have a huge US capital gains tax that you didn't expect. That's just one example. So that is the main thing to watch out for. Do not gift appreciated assets and do not move to the US with appreciated assets. Clean up your tax basis before you go there. Again, whole other presentation on that. Let's say that you are a US person and you've got both taxable accounts and a tax deferred account like a 529 plan. And you have a choice of all the investments you make. Which investments do you make in your taxable account? Which investments do you make in your tax sheltered account? Believe it or not, your things like technology stocks are things you want to invest in your taxable account. Why? Well, they don't pay dividends, so you're not going to be paying current income on them. And one of two things can happen. Either they'll go up a lot or they'll go down a lot. And if they go down a lot, you want to sell them and harvest the tax loss, which you're not going to be able to do in a tax deferred account. If they appreciate, you can defer that gain until you sell it. And then even once you've deferred it, you've got a lot of things you can do with it. You can gift it. You can put it in a charitable remainder trust. There are a lot of things you can do to possibly defer that even past that point. Municipal bonds. So for example, California state bonds, those you want to buy in your taxable account. Real estate. Why would you want to own physical real estate in a taxable account? You've got depreciation write-offs. You've got the write-off from the loans and other things that you might take. You don't get to benefit from all of those things unless you do them in a taxable account. And last but not least, MLPs and partnerships. Anything that issues a Form K-1, you want to do them in a taxable account. Otherwise, you will have a headache called UBI in your tax deferred account. So those are the things to watch out for. What do you want to buy in your tax deferred accounts, your tax sheltered accounts? Dividend stocks, anything that pays you current income that you might otherwise have to pay tax on that year, buy those in your 529, your IRA, or any of those other accounts. FX trades or futures contracts, believe it or not, those are what are called 1256 contracts. Even if you don't sell them, you will have to pay tax on them at the end of the year. So doing those in a tax deferred account also makes sense. Taxable bonds, where the interest is taxed at ordinary income. Do those in your tax deferred accounts. And real estate investment trusts, which is different than owning physical real estate. That income would be taxed at ordinary income. Do those in a tax deferred account to shelter those as long as possible. Gold and collectibles are taxed at a much higher capital gains rate. That's a little debatable where exactly you want to hold them. I would recommend if you need to have some, put those in your tax deferred account. Earlier, I mentioned this thing called a Dynasty 529. What is a Dynasty 529? It basically lets you compound the investments in that tax sheltered account, not just for your child, but for your grandchild, your great-grandchildren, and so on. The main reason we don't see very many of them is because 529 plans, as we know them, have only been around for 25 years. And so far, I haven't worked with anyone who set one up 25 years ago. So I can run you through the models of basically how the idea would work, but I've increasingly spoken with tax planners who wanted to discuss how they can use 529s really more than anything else as a long-term tax shelter. What are the most important lessons? First of all, have a plan, making sure that your actions and allocations match that plan. What are the most common mistakes I see? Number one, not having a plan, waiting too long to put money into your account, not contributing regularly enough, making one $15,000 contribution and then not keeping up with it, or not paying attention with what's going on. Another investing mistake is investing way too conservatively. I see this a lot in MPF accounts and 401ks and other retirement accounts. People will save, but then they'll have it all in the cash account or the bond account. Keeping too much cash is a terrible idea when interest rates are zero. But on the flip side, you don't want to invest too aggressively. If you have all your investments in Bitcoin, maybe you thought you did wonderfully for the past few years. I'm not so bullish on it going forward. I started investing in 98, 99, 2000 during the dot-com bubble, and I find those who chase trends got absolutely clobbered. That's an easy way to turn a $20,000 account into a $2,000 account. Last but not least, and I put this last because usually this isn't what is make or break, paying too much in fees. I spend a lot of time looking at fees, but that's something also to watch out for as a big mistake as well. Last slide here, I'm going to go ahead and put my QR code and contact information up. So at this point, I want to just make sure I go back to the screen and see if there are any questions there in the chat. So I should have mentioned earlier, there is a chat box, which if you're on a desktop, you can see over on the right side of your screen, or if you're on the phone, you might need to click that menu bar up top. It'll pull it up there. You can go ahead and type questions in the chat there, and Gerry and I will see them. Or you can also raise your hand and ask your question verbally. We'll stay on for a few minutes. Let's see if we have any questions. And otherwise, of course, you've got my contact details there if you'd like to go ahead and email me or reach at me a question afterwards. I'll also be sharing Gerry's contact information in the follow-up. Okay. So I've got one question here in the chats. Do the state funds have to be used on colleges in that state? No. Thank you for the easy question. Very, very simple. No, they do not. They can be used for any qualifying higher educational expense or any qualifying education expense on that chart that I showed you. So thank you for the question. Hopefully that flow chart was useful. Yeah, so the only reason that the states run the 529 plans is because that's how they get their tax exemptions. Now, some of the 529 plans to keep in mind, there are 529 plans, which, for example, that first Michigan one, it wasn't an investment in mutual funds. It was you were actually prepaying tuition on that college. And if you, in fact, look at the private college 529 plan, I forget which state sponsors it, but it can be used at any of those 270 universities in that particular pool. So look at the details of the plan, but the ones that provide investments in mutual funds can be withdrawn and used in any qualifying higher education plan. So I don't see any other questions in the chat. Gerry, is there any other closing remarks you'd like to make before we sign off here?
No. If there aren't any further questions, just thank you very much for attending. And if you do have any questions, you can go to our website. It's applyivy.com. And you can also email me at info@applyivy.com. So please, if you do have any questions, and we also have a free initial 60-minute consultation too for anybody that has specific questions. But thank you.
Great. Thank you very much for joining us. We look forward to seeing you.